Hi and welcome to the channel. Today I'm going to show you 5 great dividend stocks that are on a sale. First we'll find out the dividend score, and after that we'll check the valuation with the help of fast graphs. Let's not waste any time, here is the list. At 5th place we have Hewlett Packard Enterprise. This is the enterprise division of HP, so they are big on network products and servers. And on the graph we can see that they have underperformed a bit compared to the S&P 500 and has a dividend score at 4 out of 10. Let's check the valuation. Here we have HP, and as I said before, it's a spin-off of HP, so we only have about 9 years of data backwards. The yellow line is the earnings per share, and we can see that right now it's trading below the blue line, which is its normal valuation at PE 9.5. And if you project out to mid-late 2025, analyst expects an annual return of 13.4%. We can also check the analyst scorecard to see if they usually hit or miss the earnings estimates. And here we can see that there are actually 57% beats and 14% hits and 29% miss. So yeah, it fluctuates a bit. Next up, at 4th place we have Prudential. A market cap of $38 billion, and it's a life insurance company. It has underperformed the S&P 500 a bit. A nice dividend score though at 7 out of 10 points, and a quite high dividend yield at 4.5% compared to also a good buyback yield of 3.6%, so the combined yield is actually about 8% for Prudential. Let's check their valuation. Here we have Prudential in fast graphs. The orange line is the earnings per share at PE 15, the white line is the dividend, and the black line is the current stock price. And as a financial company, of course, they got hit quite bad during the last financial crisis 2008-2009, but after that no big drops. But also they're not growing that fast, and earnings growth rate at about 4% over this period. But it's a rated S&P credit rated company and also a very high dividend yield. And if we also plot their normal PE, we can see that if we project out to late 2024, an annual return of 9%. Let's also check the analyst scorecard for Prudential, and here we can see that it's only 8% miss, so analysts usually get Prudential right. Next up, at 3rd place we have AT&T. And this has been a favorite among dividend investors. Some disappointment or relief when they spun off their streaming services. And yeah, I think the graph speaks for itself. They haven't done that great, at least the last 10 years, compared to the S&P 500, which is the blue line. The dividend score, not that great either, but one can also speculate if big telecom is a bit undervalued right now. The earnings and sales doesn't look that great, but the dividend is still quite high at 5.8%, and they are only paying out 47% of their earnings, so they actually still has a bit room to increase that dividend. Let's check the valuation. Here we have AT&T in fast graphs, and the earnings are quite stable, actually increasing at about 5%. A little drop in 2020, but after that they have actually increased their earnings per share. And if we plot the normal PE compared to the stock price, we can see that the stock has been out of favor for quite a while now. So if you believe in AT&T long term, it might be actually a good time to pick up some shares, because if we use the current valuation at PE 7.5 to the normal valuation, we can actually estimate an annual rate of return of 52.8%. So let's see, are the analysts right on AT&T usually? And unfortunately, this is a disaster. Here we can see that analysts usually estimate 0% beats, 0% hits, and 100% miss. So those 50% might actually be quite lower. We can see here that, yeah, you could probably cut off a bit, about 25% of those earnings to get more in line with reality. At second place, we have Celanese, a market cap of $10 billion, and they operate in the chemicals industry. And they went about on par with S&P 500 during the last 10 years with the dividends reinvested. And here we actually got the company that had some check marks, 8 out of 10 on the dividend score. They only miss on the analysts' future EPS, and the debt is a bit high compared to the free cash flow. Otherwise, the green yield card is actually all check marks, a nice yield of 2.65%, and they are only paying out 14% of their earnings, so that's quite impressive. Let's check the valuation. Here we have Celanese in fast graphs. They took a bit of a beating in the last financial crisis, but after that it has been smooth sailing and a big spike 2021, but the earnings are predicted to be a bit down the next coming years and then stabilize again. So that's probably why we can see that the normal PE is not that high, 11.6, and the current stock price is trading far below its normal valuation. So if we believe the analysts, compared to this 6.7 current PE back to its normal valuation in late 2024, we can actually look at an annual rate of return of over 29%. So let's also check here, are the analysts usually right with Celanese? And we have about, lately 20 analysts analyzing Celanese. And we can see they actually beat 42% of the time, hits 33 and miss 25. So this looks quite predictable. And at first place for dividend stocks in December, we have Citigroup. $91 billion in market cap, the current stock price while recording this video $47.9. And in the graph, Citigroup is the black line, and it has not followed the S&P 500 since the disease pretty much. The dividend score is 5 out of 10 points, and the dividend scorecard looks quite strong actually. Low payout ratio, a very high yield, but they have not been growing the dividend lately. A bit weak on the sales though. But let's check the valuation. Here we have Citigroup in fast graphs, and yeah, Citigroup was one of the banks that got hit really hard during the financial crisis. So to make it justice, I think we need to look at a period after this, and actually let's look at the last 10 years with 3 years in the future. And here we can see that the earnings growth has been 5.6%, and the dividend is the white line. The earnings is the orange line. If we see the normal PE, which is about 10.6, compared to the current stock price, we can see that it's trading far below its normal valuation. And if we project out to late 2024, one could expect an annual return of over 32%. Once again, let's check the analyst scorecard to see if they are right. And here we can see 25% beats, 33% hits, and actually 42% miss. So this could be a nice dividend stock, but I wouldn't bet my whole dividend portfolio on just this position. It looks a bit risky, but could pay off big time. Please like and subscribe, and also watch one of my latest videos where I reviewed a subscriber portfolio. See you soon!